You could drive your car 0 miles this month and still lose hundreds of dollars. No gas, no electricity, no oil change, no parking. You could leave the car sitting in your driveway for 30 straight days, untouched, and your bank account would still get smaller. Because your car doesn't only cost you money when you drive it, it costs you money simply because you own it. And one of the biggest fixed costs hiding in that number is insurance. Here's where it gets interesting. Imagine 2 cars sitting in the same driveway. One's electric, one runs on gasoline. They cost about the same to buy. They're worth about the same. You drive them the exact same number of miles every year. So why, in 2026, can the insurance bill on those 2 cars be hundreds of dollars apart, sometimes more? Is an EV actually more expensive to insure? Or have we been asking the wrong question the entire time? Today, we're going to follow 2 specific cars for 10 years and find out exactly where the insurance money really goes. Because the cheapest car to fuel isn't necessarily the cheapest car to insure, and the car with the lower monthly payment may not be the cheaper car to own. Let's start with a real 2026 benchmark. According to Insurify's national data this year, the average monthly cost to insure a gas-powered car sits around $185. The average monthly cost to insure an EV sits around $263. $263 a month times 12 is roughly $3,160 a year. Over 10 years, that's more than $31,000 for insurance alone, before you've spent a single cent on electricity. But I need to be honest about what that number actually means. $31,000 is not what everyone is going to pay. A 22-year-old driver in a high-theft zip code can pay dramatically more than that. A 55-year-old driver with a clean record in a low litigation state can pay dramatically less. Somewhere in between sits every single person watching this right now, and most of you have never once seen this number broken out on its own before signing a loan. And that's the first thing most people misunderstand about insurance. It was never really priced around the car alone. It's priced around the risks surrounding the car. So if the car isn't the only thing being priced, what exactly is the insurance company looking at? There's a fundamental difference in how these costs behave. Gasoline, electricity, and some wear-related expenses are variable costs. They rise and fall with how much you actually drive. Insurance, registration, financing, and depreciation are fixed or semi-fixed. They show up whether the car moves or not. Picture 2 drivers with the identical vehicle and identical coverage. Driver A puts 20,000 miles a year on the odometer. Driver B puts 3,000. Despite driving less than a sixth as much, driver B gets almost no meaningful discount on their insurance bill, simply because the car spends nearly all year parked in the driveway rather than on the road. Insurance doesn't care only about how much you drive. It cares about the risk of insuring you and the vehicle, full stop.
Let's build the case study we'll follow for the rest of this video. 2 vehicles, both priced right around $45,000 in 2026. A mainstream, well-reviewed electric SUV on one side and a comparably equipped gas SUV on the other. Same driver, same zip code. We'll say a mid-sized city in Texas. Same coverage level, full coverage with a $500 deductible. Same annual mileage, 15,000 miles. If everything else is roughly equal, shouldn't the insurance cost land roughly equal too? It doesn't, because the insurer isn't just looking at the price tag. They're looking at repair cost, parts availability, labor rates, claims frequency, accident severity, theft risk, the vehicle's replacement value, the technology packed into it, and years of historical loss data specific to that model. And one of those factors has become especially important for EVs in 2026. This is where the real economics starts. A relatively minor accident on either vehicle can damage the bumper, sensors, cameras, radar units, lighting, and structural components. On an EV, that same fender bender can also touch high-voltage systems, the battery pack housing, and other specialized components that simply don't exist on a gas car. I want to be careful here, because the lazy version of this story is EVs are more expensive to repair, full stop. The more accurate version is this. Certain EV repairs can be genuinely expensive, and insurers price expected losses, not internet anecdotes. There's a useful formula hiding underneath every premium. Expected claim cost equals the probability of a claim multiplied by the severity of that claim when it happens. A car doesn't need to crash more often to become expensive to insure. It can simply cost more, on average, every time it does. This is where we need to knock down a popular myth. It's not true that any accident automatically means a battery replacement. Modern EVs are engineered with real battery protection, structural elements specifically designed to shield the pack in a crash. After an accident, the process involves inspection, an assessment of repairability, manufacturer-specific procedures for handling the pack, and ultimately a decision from the insurer about whether repair or total loss makes more financial sense. The economics of an EV accident isn't simply battery replacement. It's the entire repair ecosystem surrounding the vehicle. And that ecosystem in 2026 is still younger and thinner than the one built around gas cars over the last 80 years. But there's another reason insurers price EVs the way they do, and it has nothing to do with the battery at all. Compare the two repair worlds. Traditional gas car repair runs through a mature network of body shops, general mechanical shops, and engine and transmission specialists that exist in nearly every town in America. EV repair often requires EV-certified technicians, specialized diagnostic equipment, strict high-voltage safety procedures, manufacturer-specific parts that can take longer to source, and sensor recalibration after almost any bodywork. Insurance companies aren't simply asking, how much does this bumper cost? They're asking how much the entire claim will cost from the moment the vehicle enters the repair process until the moment it leaves. That number is built from parts, labor, calibration, downtime, and complexity, all stacked together.
And here's where the simple EV versus gas argument starts to fall apart. An EV is not automatically more expensive to insure. A gas car is not automatically cheaper. Averages hide enormous variation underneath them. Look at the spread within EVs alone in 2026. A mainstream model like the Chevrolet Silverado EV or Hyundai Ioniq 5 can insure at or near gas car pricing, while a Tesla or an Audi e-tron can run well above $4,000 a year, with the most expensive luxury EV models in the data pushing past $10,000 annually for full coverage. Meanwhile, our $45,000 EV in this case study, being a mainstream, well-reviewed model, could plausibly land closer to the newer model average gap of around 18% above its gas equivalent, rather than the much wider 40+% gap you see across the entire market, including older, riskier vehicles. Insurance companies don't insure EVs. They insure specific vehicles operated by specific drivers in specific places. Now compare our $45,000 EV to a $45,000 luxury gas vehicle instead of a mainstream one. The luxury gas SUV can carry expensive body panels, expensive adaptive headlights, advanced driver assistance hardware, premium wheels, and parts that cost just as much to source and repair as anything on the EV side. The sticker price never tells the insurer the whole story. What actually matters is the vehicle-specific loss history and the expected repair severity for that exact model and trim. But even if two insurance quotes land at the exact same number, there's still one more variable that can completely change the underlying economics. A lower premium usually comes bundled with a higher deductible. Take the choice between a $500 and a $1,500 deductible. Raising your deductible doesn't make the underlying risk disappear. It simply decides how much of that risk you're choosing to carry yourself instead of handing it to the insurer. Say raising the deductible from $500 to $1,500 saves you a few $100s a year in premium. The real question becomes, how many claim-free years would it take for that annual savings to actually cover the extra $1,000 of exposure you just took on? That's a genuine personal economic calculation, not a rule of thumb. Same EV, same model, same driver profile, now move it between two zip codes. The premium can swing dramatically based on traffic density, local accident frequency, theft rates, weather exposure, regional litigation patterns, medical cost inflation in that state, local repair labor rates, and the share of uninsured drivers on the road nearby. Your car doesn't live in America. It lives in a zip code. That's why a national average, even an accurate, well-sourced one from 2026 data, is genuinely useful for understanding the overall market, but almost useless for predicting your own personal premium. Take our case study EV and put two very different drivers behind the wheel. Driver A is 55 years old, has a clean driving record, and keeps mileage on the lower side. Driver B is 21 years old, has a recent at-fault accident on record, and drives significantly more miles per year. Same EV, same zip codes, same coverage, wildly different premiums, potentially a gap of well over $1,000 a year between them. The car was only ever one variable inside a much larger risk equation. Here's the underlying economic framework, not an actual pricing formula insurers use, but a useful mental model. Insurance cost is roughly a function of the probability of a claim multiplied by the average severity of that claim, adjusted by the insurer's own operating expenses and broader market conditions. On the EV side, the inputs leaning the number upward tend to be repair complexity, battery-related risk, specialized parts, specialized labor, embedded technology, and theft or claims data tied to specific popular models. On the gas car side, the inputs are engine and transmission repair costs, traditional mechanical systems, parts availability through a mature network, theft rates, typical accident severity, and that model's own specific loss history. There is no universal EV insurance penalty. There is only the risk profile of a specific vehicle in a specific place driven by a specific person. Now let's connect insurance back to the number that actually made you consider an EV in the first place: energy savings. Say our case study EV owner saves roughly $100 a month on energy costs compared to the gas SUV. That's about $1,200 a year, a realistic figure with 2026 gas prices sitting above $4 a gallon nationally. but the same owner is paying roughly $50 to $65 more a month in insurance, which works out to somewhere between $600 and $800 a year in extra premium. Net advantage, somewhere around $400 to $600 a year, not the full $1,200 you might have assumed from the energy savings alone. Suddenly, EVs are cheaper to run becomes a much more complicated sentence. This is exactly what total cost of ownership is built to capture. For the EV, purchase price, financing, insurance, electricity, maintenance, repairs, and depreciation all stacked together. For the gas SUV, the same categories, swapping electricity for gasoline. Here's a genuinely underrated insight. Take driver A at 5,000 miles a year against driver B at 25,000 miles a year. Insurance cost stays close to fixed regardless of which driver we're talking about. Fuel or electricity cost is entirely variable, scaling directly with miles driven. For the low-mileage driver, insurance can end up representing a much larger share of their total transportation budget, simply because there isn't enough driving happening to dilute that fixed cost. For the high-mileage driver, energy costs climb to become one of the most important line items in the whole comparison. The less you drive, the less your fuel savings can matter, and the more your fixed costs dominate the entire economic picture. Picture an EV owner without a garage, relying entirely on public charging. Insurance stays roughly the same as it would for any other owner of that model in that zip code, but charging costs can run 2 to 3 times higher than a home charging owner would pay, since public charging rates are typically well above residential electricity rates. The person who bought an EV specifically because electricity is cheaper than gasoline can discover that where they charge matters almost as much as which car they bought. This is exactly the same lesson that shows up when comparing EVs, hybrids, and gas vehicles head-to-head on total ownership cost. Location and habits change the math as much as the vehicle itself does. Back to that national benchmark. At $263 a month for the EV, that's roughly $3,160 a year, or about $31,600 over 10 years. This is not a prediction for your specific insurance bill. It's a national average, and your number could land well above or below it. Build out 3 realistic scenarios instead. A low-cost driver, older, clean record, lower-risk zip code, could land meaningfully below that benchmark for either vehicle. An average-ish driver lands close to the national numbers we've been using throughout. A high-cost driver, young, recent claims, an expensive urban zip code, an expensive trim level, can push insurance well past $4,000 a year on the EV side alone. Insurance by itself over a decade can become a genuine 5-figure ownership expense, sometimes rivaling the total amount spent on fuel or electricity. Let's go back to the hook. Say you only drive 2,000 miles this year. You still pay insurance, registration, financing, and depreciation, exactly as if you'd driven 15,000. This is where cost per mile becomes revealing. At $3,160 a year in insurance, driving 5,000 miles works out to roughly 63 cents per mile just for insurance. Driving 25,000 miles brings that same fixed cost down to about 12.5 cents per mile. Same insurance bill, completely different cost per mile. The fewer miles you drive, the more expensive every fixed dollar becomes on a per mile basis. Here's the actionable part. Before you buy, get real quotes for the exact model, the exact trim, ideally the exact VIN if the dealer can provide one, at your desired coverage level and deductible. Run through your actual driver profile. Compare EVA against EVB and ICE A against ICE B, not just EV versus ICE as a category. The accurate statement was never EVs are expensive to insure. It's this particular EV is expensive for me to insure. And that sentence can only be filled in with a real quote, not a national average. Go back to our case study one more time. The EV saves roughly $1,500 a year in energy costs, but cost about $600 more a year to insure. Net advantage, $900. Now imagine the gas SUV in a slightly different configuration, higher fuel costs, but noticeably lower insurance, and a different depreciation curve entirely. The winner isn't determined by one category in isolation. Total cost of ownership decides it every single time. Meet 3 different owners of this same pair of vehicles. Driver 1 is a low-mileage homeowner, 5,000 miles a year, reliable home charging, comparatively low insurance, and plans to keep the car for a full decade. For this driver, the EV's economics can look genuinely strong. Driver 2 is a high-mileage commuter, 25,000 miles a year, home charging and heavy exposure to today's elevated gas prices. Here, the EV's operating cost advantage becomes even more meaningful, often enough to outweigh the insurance gap by a wide margin. Driver 3 is a low-mileage urban driver, 5,000 miles a year, no home charging, and an expensive insurance profile driven by their zip code. For this driver, the EV's economics may be far less compelling than the marketing suggests. There isn't an EV insurance winner across the board. There's a winner for your specific risk profile. Let's put the entire case study on the board at once. Side panel, 10-year total cost of ownership, rows for purchase price, financing, insurance, energy, maintenance, repairs, and depreciation, minus resale value, columns for the EV and the comparable gas SUV, with a bottom line 10-year total cost of ownership figure for each. If you only compare insurance, you can land on the wrong answer. If you only compare fuel or electricity, you can land on the wrong answer. If you only compare the purchase price, you can land on the wrong answer too. The only comparison that actually tells you anything is the full ownership equation, added up together. There's no universal winner here, and pretending otherwise would be dishonest. An EV can make more economic sense when you have reliable home charging, drive high annual mileage, pay reasonable electricity rates, get a competitive insurance quote on that specific model, plan to keep the car a long time, and are buying a model with a strong warranty and reasonable depreciation. A gas car can make more sense when you drive lower mileage, have access to relatively affordable gasoline, would otherwise rely on expensive public charging, get a noticeably better insurance quote, face a lower purchase price, or are looking at a specific model with unusually strong resale value. The single most important piece of practical advice in this entire video: get the actual insurance quote before you buy the car, not after you've already signed the loan. Back to where we started. You could drive 0 miles this month and still lose hundreds of dollars. That's the strange economics hiding inside ordinary car ownership. Some costs move with the car. Some costs stay exactly where they are, whether the car moves or not. And insurance is one of the biggest costs that never cares how far you drove. That's why the real question was never, is an EV cheaper to insure? The better question is, what does this specific car cost me to insure? And how does that change my total cost of ownership over the years I plan to keep it? An EV can save you money every single time you plug it in, while quietly costing you more every month you insure it. A gas car can burn more money at the pump while costing noticeably less to insure. The winner isn't EV. The winner isn't ICE. The winner is the car with the better economics for the specific person driving it. But there's an even bigger question sitting underneath everything we just covered. If insurance, fuel, maintenance, and depreciation can each independently swing the economics of a car this much, what happens when you add every single one of them together over a full 10 years? Because that's when the real EV versus gas battle actually begins, and where you finally find out whether a decade of ownership rewards patience or punishes it.